All right, colleagues, welcome back to the conversation. I'm excited to come back and to continue with our conversation. I was recording that for the purpose of our conversation, the companies are divided into those that are able to manufacture their own goods and sell. Then we also have those, that just sell the goods that they purchased from the suppliers, right? They buy the goods that are finished, already finished goods, and then they sell them. In other words, they don't manufacture. We have these companies that don't manufacture, right? So that's what we made mention last time, and this is what we are making mention. Then it is also important to record at this very point that when you have these companies that do manufacture, right? These that do manufacture, they need to establish if they have made any profits or losses at the same time, right? They have to establish whether they have made any profit or any loss. Now, there are different methods that are used to establish whether the company has made profit, a manufacturing company for that matter, if it has made any profit or loss. There are those methods that are available. And then those that are examinable to you is just the marginal costing approach or the absorption method. That is what we talked about, and this is what we are saying. So now, riding on the same, we have a question that we are actually given. We're given a question that needs our attention, and the question that we do have is here and the reading, and I am reading on your behalf. The question is reading. Let me read in your hearing. It says, the objective of this article is to present with the detailed workings. Number one, the structure, the content, and the format of the profit statement that are prepared by these. And this is what we are going to do. So we are given an example where we are given a public limited company that manufactures and sells a simple product. So the following are the budgeted and the actual values. Of course, those are actual levels of production, the budgeted ones and the actual ones. And you're
Excuse me,
given
sir.
this information. This is the information that you have, all right? Now, writing
Yes, sir.
on this very information.
I'm going to
Okay,
ask you if you can zoom out a bit.
okay. Let me try. Like this. How is
Again?
it now? Again. Okay, let me try to put the class
Okay.
the what's it like this.
Yes,
How
yes.
is it now?
It's much better now.
Okay. I guess we are really good.
It's okay
Okay.
now.
Okay, thank you very much. So I was recording that. So these companies they need to prepare the profits or loss, right? Using these particular methods. So the first one that I want us to go through is what is known as a marginal costing method. One more time. Now, before we get to this example and do it, let me quickly remind you of the format. I will be very quick because we already did the format, you have it. But let me just remind you so that when you are doing, you are not really suffering. You are able to remember this without too much struggle. So we made mention last time that the first thing that you do when you're dealing with marginal costing is to determine revenue, right? You have to determine revenue or sales. And then this revenue is pushed in the last column, right? The revenue that you have is actually pushed in the very, very last column. Okay. So now when you push this particular revenue in the last column, you got to deduct the following. You have to deduct the costs, the costs, the cost of sales, right? Deduct the cost of sales. And what are some of the costs of sales that you are deducting? This time around, we are just deducting the manufacturing costs, or the variable manufacturing costs. Simple. Let me repeat. We are just deducting the variable manufacturing costs. That is what we do in marginal costing, just the variable ones. So the variable ones are those marginal costs that really change, as the level of production changes. Let me say this again. So we are saying that they do change as the level of production does what? Changes. So when level of production increases, they do increase. When the level of production goes down, they do go down. For example, we have direct material costs. So direct material costs you record here, and how you find it, you just basically, of course, you just multiply the direct material cost per unit, for example, the one that we have, this 8 times the number of units that were produced. You're going to see that. Of course, before you get to this, you put the opening inventory here, the opening inventory, you put there. Then you also have direct labor costs, right? Direct labor costs. We said you record the direct labor costs here. Then from direct labor costs, what else is variable? There is variable production overheads, all right? Variable production overheads. No fixed costs. Remember, we are not dealing with fixed costs here. We just want variable costs. The variable production overheads. And we say the word overhead is just a collective term. That simply means indirect costs, right? It's just indirect costs. So when we say variable indirect costs, we are referring to those overheads, right? The variable overheads are the indirect costs that, that cannot be traced directly to a specific product that is being produced. Because the way the indirect costs, we say the indirect cost simply means those costs that you can't really trace direct to a specific product or a specific service that you are producing. Is that clear? So after you have done that, the next thing that you need to do is to consolidate all these, and this is what you will have. You add all these up to here. I'm just asking for a minute. Yeah, so that's that. Then when you consolidate all these, you will need to do what? What do we do? What do we do from here? Do you remember? Have we been studying? Or we no longer remember this stuff? Hey, colleagues. Okay, so you have to this value, right? You have to add to this value that you find, you have to add the non-production variable costs. You get it, right? Non-production, the keyword is non-production. Those that don't take place in the factory, or non-factory variable costs, like maybe sales commission, variable costs, all those variable costs that are non-production, you put them here, you add them. And when you add these two, the value that you find is what you push in the last column and deduct from the revenue. So that what you can have what is called what? Contribution. This is the first part of our conversation. I want you to follow nicely. I talk about the format first so that we have no problem when we are putting. I'm reminding you. So I am saying that you will have contribution, right? What is contribution? Contribution simply means revenue less variable costs. Is that clear? So from revenue, if you deduct the variable cost, you shall have what we call contribution, not the profit. You remember? From the normal profit and loss statement that you learned in accounting, basically when you deduct, revenue minus the costs, if you are deducting the full cost, both fixed and variable cost, you will have gross profit, isn't it? You're going to have gross profit. But when you're dealing with marginal costing, what you will have is not gross profit. No, it is called net profit. Is there any question up to here? Do I have any question to pick? We are working with the format, then we do the question, then that's when you will be fine. Okay? Then from here now, you can then go ahead and less all the fixed costs. Can I just erase this and start writing from the top part, because the screen, the space is finished going down from my end. So let's say this is contribution. I've brought contribution on top. So for you, you have to continue writing going downwards, right? Okay. So from contribution now, when you find contribution, what happens next? So there, you less all the fixed costs, right? You less all the fixed costs, the fixed production costs, fixed administration cost, fixed selling cost, all the fixed costs. In short, you are going to less all the fixed costs. So less what? Fixed costs. You less the fixed cost here. What fixed costs do you have? You can have the production fixed costs, put them here. You have administration fixed costs, right? Put them here. You could have the selling fixed costs, put them here. Then you add them. And the answer you find, you push in the last column, then you deduct it from where? From contribution. You get it, right? You deduct it from contribution. And what you will have is what is called the net profit or net loss, right? Net profit or net loss. If it's negative, it shall be net loss. If it is positive, it shall be net, if it's negative loss, then if it's positive, net profit. Any questions? Are we good with the format? Are we okay with the format? You can give me a shout. We are good. We get started. Hello. Are we still connected?
Yes, sir.
Yes, yeah.
All right. Now, if we are connected, then we can proceed. Let's proceed. So what is the first element that we look for? We need to find,
We need to
because we
look
need
for
to
the
do
revenue.
revenue, yes. And we are told that there is no what? There is no opening inventory at the start of May. So there is no what? No opening inventory. Very important to take that home. Okay. We are yes. There is what? There is a you start with opening inventory. How do you find opening? Oh, you start with revenue. Sorry, I'm speaking against what I taught you in the last 2 minutes ago. So how do you find revenue? Revenue is simple. We are just you do for May and June. Let's do for May first. Let's concentrate on May. So it is how do you revenue sales? It is basically the selling price times what? The units sold. You're following, eh? Selling price times the units sold. You can do that quickly. 300 times 50. What do you get? Please do this quickly with your calculator so that we make good progress. What do you find? Tell me, what is it that you find? 50, the selling price per unit times the units that were sold, they were 300.
15,000.
What do you find? 15,000. Thank you. So you have 15,000. Then from there, what do we do according to the format that I gave? We less cost of what? Cost of sales. Have we forgotten already? Then from the cost of sales, we start with opening what? Opening inventory. And the question is clear that for May, we don't have what? We don't have the opening inventory. Is that clear? If you had the opening inventory, you could have written it. What do you do next? Direct material costs, isn't it? You still remember the format? Yes, sir, you remember. Direct material costs. How do you do it? The material per unit, this is the direct material cost per unit, times the units that were produced. Now, you work with production if you're establishing the cost. So 500 times 8, what do you find? $500 times 8?
4,000, sir.
Okay, so it is 4,000. It is 4,000. All right. Then from there, you can go to direct labor costs. Direct what? Direct labor costs. Direct labor cost is 5, right? 5 per unit times 300, 500 units that were produced. How much do you find?
Sir,
How
I
much went
can't
for
see
it?
where you've gotten the 500.
It's here. Production, like the units that were produced, units that were sold. Are you able to see it now?
Yes, sir.
Okay. So 500 times what's this? 5.
2,500.
Yes. Just think of it in terms of man. Eh? You'll be quick to find the answer. Let's go to what comes next according to the format that the teacher has given you. What follows next? Do you still remember?
Is it the variable production overhead?
Exactly. You put the variable production overhead. And the variable production overhead that we have in the question is what? It's a 3 per unit, right? So it's a 3, this is 3 here, times the units that were produced here is 500. So you say 3 times 500. What do you get? What is 3 times 500? The 500 quarters. Yes,
1,500.
1,5. From here, what did I say? What do you do next?
You add up and then you subtract from revenue. What you get is contribution.
All right. So let's consolidate first. I'll ask the question later. So variable production overhead. Let's consolidate. What is the sum of these? 4,000 plus 2,500 plus 1,500.
8,000.
8,000. Now, what do you do after 8,000? This is very important. What did I say in the format? I think in the last 10 minutes, I was giving the format. What do you do?
You add the non-production overhead.
Yes, you add the non-production overheads. So the non-production overheads, what is being said? What is it saying? It is supposed to be the variable sales commission, 5% of what? Sales revenue, which means this 5% of this revenue that we have, the 15,000. So what is the 5% of 15,000? So these are non-variable, right? Add non-variable production overheads. What is that? Like, what is the 5% of 15,000? You say 5 divided by 100 times 15,000.
750.
750. Everyone finding the same? Okay. Are we all finding the same? It is 750, huh? Okay. Then from there, what do we do next? Whatever you find, you push in the last T, add this, and there sum, you push in the last column. So what is the sum? 8,000 plus 750 to be 8,700 and what? And 50, is it? Then you'll have the contribution. How much is the contribution? You deduct this contribution from sales or from revenue. From this figure here, that's the revenue. What do you find?
6,250.
6,250. Everyone finding the same? Or have we deducted the closing inventory? We have not yet deducted the closing inventory. Seems we have not yet we need to deduct the closing inventory before we can do that. Sorry.
So in this
The
case, where
closing
is it?
Yes. Sorry, this was this. We need to deduct the closing inventory before we do this addition. Where is the closing inventory? We need to find the closing inventory. Let's find the closing inventory. Sorry for that. Deduct the less the closing inventory. How do we find the closing inventory? Now listen, for closing inventory, it is basically the difference between what was produced, the units, minus the units that were sold. You're following, times this cost of production, the 80,000. You get it, divided by the units that were produced, which is actually 500. That's what you do. Did you hear what I said? I should repeat that, right?
Yes.
So, yes, I am saying to determine the closing inventory, it's the units that were produced. You produced in May, you produced 5,000 units, right? And then you just sold the 3,000. You're following, right? So that's what we mean. So the units that were produced for 5,000, you sold 3,000. Take the difference of that, then you multiply by the costs of production, the variable cost of production. The variable cost of production is just made up of these three in this case. You don't have to include the opening inventory when you are ascertaining the cost of production to put here when you're determining the closing inventory. You have not heard this one. Let me repeat. I am saying when you're finding the closing inventory, right? You have to less the units that were produced minus those that were sold times the cost of production. In this case, since this is marginal costing, the variable cost of production. And this variable cost of production does not include the opening inventory in that case. You will not include the opening inventory. It's just that amount that you put. So that has been clarified. So how many units were produced? 500 less the units that were sold were 300, right? Which gives us 200. So it's just 200. So you shall say 200 times the 8,000 divided by 500. Is that clear? That will give you your closing inventory. Okay? Did you get that? So say 200. You know where the 200 is coming from, isn't it? 200 multiplied by 8,000, then you divide by 500. What do you find?
$300.
3,000? Just a 3,000 flat. 3,200, yeah? Everyone finding 3,200, isn't it? 32, right? So you can now deduct 8,000 minus this 32. What do you find? Hello? 4,800. Now it is this 4,800 that you usually add to this opening inventory, because the opening inventory is usually somewhere here. So you add this to the opening inventory, and when you add this, for example, it will give you 48. Then 48 plus now these non-variable costs, these non-production variable costs that you, like this one, the variable sales commission, the 5% of 15,000 that you did. These we call them the non-production or non-factory variable costs. So you say the 7 what? 750. Was that? Was it 750? Did you say 5% of 15,000 is 750?
Yes, sir.
750 plus 8,000.
Plus 48. 4,800 plus 750.
800.
What do you find?
5,550.
5,530. Everyone finding the same? 5,530. Is that the case with everyone? Are we all finding the same?
Yes, sir.
Then you can deduct that now from 15,000. This is what you can deduct from 15,000 to get the contribution. So I'll repeat, maybe for the sake of, for us to understand properly. I said that when you add this plus these variable costs, they give you, for example, this figure. Then from this figure, you deduct, you can go ahead and deduct the closing inventory, right?
Sir,
You let,
sorry to take you back.
yeah.
Just rub your board and then we start where we are finding the closing inventory. I've gotten confusion here.
Okay, we start afresh. But we should keep
Yes,
the
on the
figure so that
closing
you don't
inventory.
start
To find
calculating
the closing inventory.
Okay. We should keep these figures so that we don't get further confused. That's fine. Let's start from the closing inventory. I said that, colleagues, when you find this, you have this 8,000. We are good with this. This 8,000, please, does not include the opening inventory. Actually, for that matter, let me put the opening inventory in this line in the middle column here. For example, you put it somewhere here. This is where your opening inventory is, so that you don't get confused. So when you have this 8,000, you have to determine the closing inventory. To determine the closing inventory, I said, and I am saying, you go, you check how many units were produced. The units that were produced minus those that were sold. Okay. All that multiplied by the cost of production. Which cost of production? This cost of production that you have established, the variable cost of production, right? Then you divide by the units that were produced. You get the point, eh? Divide that by the units that were produced. Simple. I'll go through again. The units that were produced minus those that you sold, multiplied by the costs of production. And I've told you that the cost of production is this one that you establish here, the 8,000 in our case, and then divide by the units that were produced. When you get to May, in May, the units that were produced were how many? They were 500, right? We sold 3,000, giving us the difference of what? The difference is just what? It's just 200, isn't it? You are following, eh? Times the what? Times the 80,000 divided by what? Divided by the units that were produced were 500. And that is how we found the closing inventory. Are you fine? Hello? Is the
Yes.
person questioning fine? Okay. So what was the closing inventory? What was the closing inventory?
3,200.
Sorry?
4,800.
4,800. Okay. You
No,
said
sir.
4,800 or 3,200?
3,200.
3,200. Okay. So when you deduct this from that, what do you find?
4,800.
This 4,800 now, it is what you add to the opening inventory. Let's assume you have added it to opening inventory, because the opening inventory in our case is 0. There is no opening inventory in this case. Then to this figure, you add the non-production variable costs, such as the sales commission. Sales commission is said to be non-production variable cost because it doesn't happen in the factory. You understand, eh? It is not happening in the factory. That's why we say it's non-production or it's non-factory. So you add to this figure non-factory production overhead, which is 5% of sales revenue. In this case, you follow what the question has given you. Our question has given that it is 5% of sales, which is 5% of our sales, 15,000. We found 750. You're following, right? Then you add these two. The answer you find, you push in the last column and deduct from sales. So what do you have when you add 48 plus 750? What did you find? What did you find? We have lost the figures again. Sorry?
5,550.
5,550. Like this, 550. Everyone finding the same?
Yes.
Right? Then let's deduct it from sales to find the contribution. Can you deduct that
So the
from
contribution is 9,450.
Those who, I'm just writing from top because of space, eh? You can continue writing going down in the last column. You said it's 9,000?
9,450.
9,450. 9,450. That's how you find your contribution. So I'll erase because of space. Then from the contribution, what do we do? What did I say? From the format I gave you. You less fix the cost, isn't it? Yes. Less fixed costs. And our fixed costs are given in here. We have fixed production. How much is our fixed production overhead? The question is saying the fixed production overheads are budgeted to but how much? 4,000, right?
Yes, sir.
Yes. The fixed production, they are budgeted at 4,000 per month. So these are fixed production. You put this in the first column, 4,000 plus the fixed administration.
Remain with a bereaved family.
It is 2,000.
Many across the nation.
And from the 2,000,
respected and
and
honored
the fixed selling.
his service.
Our fixed selling is what? It's 4,000 as well.
Zambia is a nation in mourning, not just for the loss of our former head of state, but for the last of the 6 men who.
Okay. Yeah, let's continue. Don't worry. So you can add these fixed costs. What do you find? Add the fixed costs, you push in the last column.
10,000.
What do you find? Sorry?
10,000.
10,000.
10,000.
All right. So you can less contribution. You can less it from contribution to find the net profit. What do you find? It's a loss, yeah? You have a net loss, isn't it?
Yes, sir.
How much is the loss?
Negative 550.
550. So if it were positive, you could have said the net profit. So this is how you deal with the what's this marginal costing, colleagues. Is there any question? We have just done the first part today for May. In the next class, we can do for June, so that you see you can even do for June. I think just take it that the closing inventory for this year will be your opening inventory in June. Yeah? Your closing inventory in May shall be your opening inventory in June. You can try this one. I think I should give you this question to try. I'll give you, you can try for June, same way. Just know that where there was opening inventory there, put the closing inventory for May. Simple. It is your simple exercise to practice.